Okay, so this is a presentation about apartment syndications and kind of what in the world these things are, and just kind of a simple breakdown, kind of a 101 level of what apartment syndication is and how it makes sense for passive investors. So I kind of go through some of the basic explanations of how you can get, kind of think about these things. Let's see if I can find how to drive. Okay, so quick agenda. You're going to go through what the real estate syndications are. We're going to explain some of the definitions here of the GP and LP. What does this stuff mean? A capital stack, all that sort of thing. And then we'll talk about the roles and responsibilities of these parties, how profits are distributed, and some factors to consider when investing as a passive investor. And so feel free to drop questions in the chat as we go along. And let's begin. So simply stated, a real estate syndication is an opportunity for investors to pool together their resources so that they can finance, take down, purchase, and develop and manage a real estate project that is probably bigger than they can do by themselves. So these are typically done on larger commercial transactions. It could be something like apartment complexes. It could be mobile home parks. It could be a development. These are big real estate transactions that the average person doesn't have $10 million in their back pocket and needs some help finding some resources to take this thing down, and in so doing, share the profits. And so the lead party is referred to as a sponsor, and this can be one or more people or entities. That is typically referred to as the general partner or GP. And this is the person or persons that identifies the investment opportunity, does all the negotiation to buy the property, what it's going to be bought for, all the inspections and kind of the due diligence that's required. And then they negotiate the terms of the investment, and they raise capital, and they get the debt lined up. And then they manage the project after it's been purchased. And then they share the profits with the capital investors, which are referred to as limited partners or LPs. And so these are the investors that bring their capital to bear, and they receive a share of the profits as a result of participating in the project. And they are completely passive and really don't call any shots. They have limited liability. They are just buying shares of a project. And typically syndications are done on a per project basis. There is a structure where you can put it into a fund, and then the fund goes and buys a bunch of deals. But in the syndication situation, it is on a specific project. And by the way, funds and syndications are set up in very similar structures, but for the sake of syndications, it's typically on a per deal basis. So the roles and responsibilities of a GP, the general partner, is that they find the deal, they get the financing in place, they manage the property, they are in charge of sharing all the profits with the appropriate parties, and they're basically in charge. They're the quarterback. They execute the strategy, and when it's time for the project to be sold, they sell it. So the limited party or limited partners are a passive party, and they simply provide capital, and they do their own due diligence and make sure the deal makes sense for them and their financial goals. And they are a completely passive endeavor. And this is what is referred to as a security. So it is you're just buying shares of a project, and you really don't have much say in the deal. You can ask lots of questions, and you can be kind of on it and make sure people are doing things the way they should, but you don't really have a lot of means to do anything to the project because you are a limited partner. And as a result, you receive the profits, and you often receive a quite a bit bigger share of the profits, which I'll show here in a second. Okay, so the capital stack. So this is referred to as the money needed, the funds needed to take down a big project. So let's say there's $10 million apartment project, round numbers, and they are able to get qualified for a, say, 60% loan to value loan, which is referred to as the senior debt. It's in first position. It's typically a big bank that lends with the most conservative interest rate in terms, but they are in first position. So they get paid back first when things get paid back. The second lender, if used, is referred to as a mezzanine lender, and they will sometimes lend another 10-15% on top of the project. So let's say in this case they lend another 10%, so now the project has been funded up to 70% of the purchase price. So now the sponsor has a problem. They have raised, in this case, $7 million for a $10 million project, but they need to raise another $3 million. And that's where they put together the syndication and raise the remaining $3 million. And that can be spread out over preferred or common equity. And you don't have to have preferred equity. You can just have common equity. Preferred equity has become more common in the last year or so because the senior debt has become more conservative and they're lending. They're now lending smaller amounts. And so sometimes the sponsor needs to find somebody who has a little bit bigger chunk of cash. They may bring in, say, $1 million, and they'll get put in preferred equity position, but they'll get a slightly smaller return than the common equity. And the common equity is last in line, but gets the highest return. Right. Next is how these profits are distributed. And so you refer to the term as preferred returns to the common and preferred equity. And so the preferred return is paid back first, and then there's a split of equity, say 70-30, 70% of the remaining profits go to the LPs, and the remaining 30%, say, go to the GPs when they do the equity split. And this is kind of referred to as a kind of a waterfall distribution, and this will make a little more sense on the next slide. So within the way equity is split is referred to as this waterfall structure. And it doesn't have to be this complicated if you don't want to. It can get very complicated, or it can be very simple. And you could not even have this section right here. You could just have a 7% preferred return. All the profits go to the cash flows, and the profits go to the LP first, and then the remaining is split 70-30, and that could be it. And they could be nothing more than that. Or if they hit a certain level, say once they hit a 15% return, then there's a 50-50 split. And this is the incentive for the GP to perform better. So the better the project performs, the more money the GP makes. And up until this point, the GP is not making a lot of money. They may make a few fees and kind of asset management, and there might be a little bit like acquisition or project fee or something when they first start, but that's usually like only 1 or 2%. Usually the big money is not received by the GP until they have actually executed on a project, they have cash flows coming in, and they're making above their preferred return. And this is just more complicated ways to do it if you wish. There's just different ways of setting up the project depending on if it's a cash flow or refinance or like a sale of a project. Okay. Oh, so what happens here is this is the way the cash flows are split. When there's a refinance or a sale of a project, this is the way they're shared as well. So again, the LPs always getting paid back first. So in the waterfall structure, basically all these things are getting paid back in the reverse order. Okay. Well, that's not true. The senior debt is getting paid back first, but once it gets to equity, then it follows the equity waterfall structure. All right. Now, factors to consider when evaluating a syndication. So if you are an LP and you're looking at considering investing $50,000 or $100,000 into one of these projects, you want to look to see if that project makes sense. Does the forecast that they're saying seem reasonable? Is the experience of the general partner something that you can kind of get behind? Do they have a track record? And does the investment strategy work? Does it feel like that they have their heads around how to make this thing profitable? And are they in a good market? So if for example, if you're in an apartment complex and say it's in Dallas, that's pretty exciting. If it's in Memphis, you might want to think twice. You want to make sure that even within Dallas, it's in a good area, not a bad area. Or if it's in a bad area, what's their plan for turning it around? So property management operation efficiency is, like who's going to be doing the property management? Who do they have experience with this? Do they have boots on the ground? Do they actually know what they're doing? And does the projected returns meet your goals? Do they have a way for factoring out any kind of risks? What happens when they buy the property and taxes go up? Is there a plan for that? Exactly. And then kind of what's the timeline. And so very often the timeline on these apartment projects are 3, 5, 7 years. So you're going to put your cash in there and you'll get cash flow from the profit as it comes in, but you won't get your principal back for 5 or 7 years in some cases. All right. So this is some of the terms that you think about as a passive investor. These are kind of the returns on investment that you're thinking about. So is there a preferred return of, say, 7%? Is it 10%? Is it 12%? And if it's, as high as 12%, how is the GP going to make money? And if that's the case, then you want to understand the project plan and figure out because you want the GP making money, or else why would they stay around and manage the deal? And then IRR is referred to as the internal rate of return. And this factors in your annual return over time. So typically, when you put in, say, $100,000, the first year, you may not get your full pref, or you may not get very much over your pref because they're just starting the project. And as the project matures, the returns tend to get better. And when you factor in how long your money was out over, say, a 5-year period, then you figure out what is your average internal rate of return per year over that time. So in the first year, it may only be 5%. The second year may be 8. The next year may be 15. The next year may be 20. And then let's say the average it all out, and it's like 12% IRR. And the equity multiple is, if you put in $100,000, 5 years later, you get $220,000 back. You got a 2.2 equity multiplier. And so you want to figure out how long it's going to take for your money to double. How long is it going to take for your money to grow over this time frame? And that's kind of a different way of addressing and speaking to IRR. They're kind of two sides of a coin. Okay, so quick presentation. Key takeaways here are, if you have capital to deploy, review these projects, figure out if they make sense, get on a lot of people's sponsors lists, and just start looking at projects. And then as passive investors, look into which one of these things makes sense. Is there a particular sponsor that you just kind of connect to, and learn how to evaluate projects and do your own underwriting as an LP investor. So that was a very quick presentation. When Q&A is available if you have any questions, or otherwise it'll be the fastest presentation I've ever done. I think we're 16 minutes into this. Oh, you know what? I think I realized that I didn't enable people to chat. Everyone. All right. Now, if you want to ask a question, you can. I was wondering why everybody's so quiet. You can. Now you can ask a question. And I'm not seeing any questions. You probably gave up on trying to ask questions because I didn't let you at first. Okay. We're going to make this quick and dirty tonight. All right. I'm going to call it tonight. I will post this replay on YouTube if any of you have questions. Thanks.